Everyone is always interested in investing in the best sectors at the right time in the market. This is not always easy to do. No one knows for sure exactly what is going to happen. However, we can do our homework and find out what sectors and stocks have the best chances of doing better going forward. In this video, we discuss exactly why we think now may be the perfect time to buy LEAPS options in the financials. We also discuss how all the different sectors are positioned for 2023. We look at 3 of the top bank stocks to determine exactly which one is best. We discuss what a LEAPS option is and why it's better than buying stock outright. And finally, we show how to place the trade and buy the LEAPS option in the best bank stock. Hey guys, Darren here. Thanks for joining. We talk about utilizing stock options in order to increase profits and reduce risk in your portfolio. We talk about the latest economic news and specific stock option trades that you can place today. Please be sure and check out the free options workshop in the link below. It talks about the 2 main reasons why options can be less risky and more profitable than just buying stocks alone. It goes into some detail about how being able to profit in both directions as well as being able to pick win percentage gives you a huge advantage over just buying the stock, especially in this market with swings up and down and high volatility. That is good for option traders as we can collect more premium when we trade options. Also, please hit the like and subscribe buttons below. I'd appreciate it as it really helps get the video out to more people. Lastly, a disclaimer. I am not a financial planner and I'm not recommending trades. Please do your own research and talk with your financial planner when placing trades. If you are new or learning options, I recommend you start small and always continue to invest in your 401k, IRA, or separate savings account conservatively. I look at my options trading account separately as a business in itself. All right, guys, what sectors are positioned to do well in 2023? Let's look at the FactSet earnings insight for this week and the overall market. You can see here that the earnings growth for Q4 2022 is expected to decline by -5%. Now you can also see that the earnings outlook for the first half of 2023, so the next 6 months, is pretty bleak as well, with earnings declines of -3% and -2.4% for Q1 and Q2. It's not until the second half of 2023 when we start to rebound and have positive earnings growth. The current forward PE of the S&P is 17.8, which is above the 10-year average of 17.2. So stocks are not necessarily cheap right now. We still have a lot of companies set to report. Earnings may be disappointing, which can bring the PE down and be a good time to trade and invest long to the upside. So what can we do now? Well, there are individual sectors that should still do well in this market. Let's take a look at the Q1 2023 expected earnings growth from FactSet. As you can see, consumer discretionary, industrials, energy, and financial are all expected to have positive earnings growth. If we look at the revenue growth, financials is expecting to see the largest revenue growth. This is due to the higher interest rates that they are collecting on loans. So that is for Q1. However, stock prices often move upon investor sentiment in advance of the actual numbers occurring or being reported. So I like to look further out so we can see where the sectors are expected to be heading over the full year ahead. Now, if we look at the whole 2023 calendar year, we can see that the financials and consumer discretionaries are still expected to outperform the market as a whole by quite a bit. The S&P is only expected to have earnings growth of about 3% versus 13.5% for the financials and a whopping 30% for consumer discretionaries. So now we've looked out for the quarter and the year ahead at the expected earnings and revenue growth. But let's look at where the sectors are today price-wise. So here's a chart of the PE ratio, which is the price to earnings, of the different sectors. We see that the PE of the consumer discretionaries is the highest, and the PEs of the financials is one of the lowest at just 13. So, is now a good time to invest in banks? Banks are a great place to invest in strong economies. When consumers are spending and unemployment is low, That is when profits tend to grow and loan defaults are typically kept in check. On the other hand, banks tend to perform quite poorly during recessions and other uncertain times. So banks are cyclical businesses. There are a couple of reasons why banks tend to perform poorly during recessions and other difficult economic climates. For one thing, they can face a wave of loan defaults if unemployment rises. Also, consumers pump the brakes on spending during recessions, which leads to lower demand for loans. I think we are past that now, and the risk should be very low. So since the S&P earnings growth is expected to turn positive in the second half of the year, we should consider getting out in front of it while the stock prices are still low. So yes, I do believe now is a good time to invest in the bank stocks. Do you think the same? Let me know in the comments below. What are the 3 top bank stocks to consider investing in now? Let's take a look and compare Bank of America, Wells Fargo, and JP Morgan Chase. We will look at the fundamentals, the technicals, which is the price charts, the latest earnings reports, and news. We will also look at the options in each and determine how to best play them in the market going forward this year. With Bank of America, let's start by going to the summary page of ticker BAC on Yahoo Finance. We're going to look at some of the key fundamental factors. We have the PE ratio, price to earnings, of 11, which is very good. It's under the historical 13 PE for the financials. It has a good dividend at 2.48%. So people will invest in Bank of America for that alone. We don't receive it when we trade options, but it's built into the option price. The current price is 35 and the 52-week high is 50. So there's still a lot of room to move to get back to that price. Now, if we switch to the statistics tab on Yahoo Finance, we can look at some other parameters. We can look at the price to book, which is 1.15, and anywhere in the 1 range is good. Price to sales of 3 is pretty typical. The 30% profit margin is very good. Year-over-year quarterly earnings growth of 4% and the earnings per share growth is positive as well at 1.7%. Return on assets is how a bank makes money, and 1% or better is good. Bank of America is close at 0.88, and return on shareholder equity is very good at 10%, right where it should be. The cash position versus debt is good at almost double the debt. So they will be able to survive any downturn and do well long term. All right, you get the picture of what to look at and where to grab these numbers on Yahoo Finance. So I'm not going to go through this with Wells Fargo and JP Morgan, but I'll just let you know the numbers. I've written them down in this chart. In looking at the numbers, we can see that Wells has the highest PE at 14.7, so it's not the cheapest. Wells Fargo also has a bit of risk. In December, it agreed to a $3.7 billion settlement with the Federal Consumer Financial Protection Bureau for widespread violations in the way it managed auto and mortgage loans. You can see where it is hit in the fourth quarter numbers and has negative revenue and earnings growth. Wells has put a lot of these big things behind them, so it will change going forward with time. The biggest limitation on Wells is still the asset cap because it essentially prevents it from building up its balance sheet, which is a key way banks make more money. Wells could be a little more risky, but it still has a big upside. JP Morgan Chase is one of the most profitable of the big universal banks. The bank has operations in just about every area of both commercial and investment banking, and it has done a particularly great job of expanding its credit card and auto loan businesses. JP Morgan Chase has also done an excellent job of embracing new technologies, and it's made some key investments in some fintech companies. The consumer banking operation is one of the largest in the U.S., and it also has a very large investment banking operation. This can be a positive catalyst in turbulent times since activities such as trading tend to perform strongly in volatile markets. You can see that it's high priced at $140 and it's 88% of its 52-week high. Now, moving on to Bank of America. Bank of America is my favorite of the 3. It has made major improvements in efficiency while building out its online and mobile technology. Bank of America is in a strong position to benefit from rising interest rates. It has a combination of an excellent retail banking operation as well as an investment bank that can benefit from market volatility. It's a great overall bank with a low price, solid fundamentals, and great upside. So it's my number one bank that I'm investing in now. So let's take a look at buying a LEAPS option in Bank of America. What is a LEAPS option? LEAPS options are long-term options that have an expiration date that is further out than traditional options. The name LEAPS stands for Long-Term Equity Anticipation Securities. There's an S in LEAPS, and it is not plural. The S stands for securities. LEAPS options were created to give investors the ability to trade options with a longer time frame. A LEAPS option is a bullish, defined risk strategy that profits from the stock moving up in price through the expiration of the option. It is accomplished through buying a deep in the money call with an expiration date 1 to 2 years out in time. LEAPS options are one of the few strategies that we use where we're buying options and paying the debit instead of collecting premiums, which is what we normally like to do. So we will buy a deep in the money call in BAC, Bank of America, on the Tastyworks Trade platform. We are going to go to the Trade tab and punch in the ticker BAC in the upper left. We want to pick the expiration date in the regular option chain that is more than a year and closer to 1.5 or even 2 years to expiration. So in this case, we pick the January 25 option chain with 719 days to expiration. We look to buy the deep in the money call option. We go deep in the money to bring the cost of the option down. With the current stock price at $35.45, we buy the 20 strike option for $16.65. Think about it. There's already $15.45 in intrinsic value built into the option. The current $35.45 stock price minus the $20 strike price equals $15.45. Since we are paying $16.65, it's really like buying the option for the difference, $16.65 minus $15.45 or $1.20. What a deal. We click on the ask to buy the 20 call option. We switch to the curve mode by hitting curve in the trade tab. It's a little more visual and you can see the profit zone in green. So we are buying the 20 LEAPS option with 719 days to expiration. This doesn't mean we need to hold the option that long. We can sell the option whenever we want prior to the date. Because we are going deep in the money, the LEAPS option value will closely replicate the profit and loss of owning 100 shares of stock outright. We continue to make more money as the stock moves up in price, just as if we own the stock. From here, we hit review and send and check and make sure everything is correct as it should be. We then send the order and place the LEAPS option trade. Now, let's take a look at some of the parameters and break down what we are doing. As far as the setup, we buy the deep in the money call option 2 years out. The assumption directionally is bullish. We hope the stock goes up. As long as the price moves up, we continue to make money just as if we owned 100 shares of stock. We do this in low implied volatility. We pay less for the option when IV is low. As you can see, the IVR of Bank of America is 1, which is about as low as it can be. So we pay less for the option, and it's a great time to buy LEAPS. The max profit for a LEAPS option is infinite. The stock price can move up infinitely. The buying power is the max loss. We can see in the lower right the buying power effect. This is the amount of capital that is required to place the trade, or in other words, it's how much capital the trade is utilizing. Since we are buying the option, the amount that we pay is also the max loss, and it's also the amount of buying required to place the trade. So it is a defined risk trade. This is the beauty of the LEAPS option over buying 100 shares of stock outright. The cost to buy 100 shares of Bank of America at $35.45 would be $3,545. So since we're paying $1,665, it's less than half the cost to control the same 100 shares. If the stock did move against us down, that is the max loss. So we would lose much less than if we own the 100 shares outright. So some of the key takeaways. The LEAPS option is a cost-efficient way of investing. We are able to control the same number of shares for less than one half the cost while limiting our downside risk. At the same time, our upside is uncapped. Now is a great time to consider buying a LEAPS option in Bank of America. All right, guys, thanks for watching. Please be sure and download the free options workshop in the link below. Also be sure and hit the like and subscribe buttons and leave a comment and let me know what you're trading today. See you in the next one.